Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast episode 122, podcast episode 112 for the week ending February 17th, 2022. Welcome one and welcome all. We've got a lot to cover. Market's a little weak today on the Russian noise. We'll get to that here before the close, and want to kick it off by doing the quick media. Want to thank Liz Clayman and Ellie Terrett for having me on the Clayman Countdown Fox Business yesterday to discuss who's the bigger threat, Vladimir Putin or Jay Powell. So we'll talk a little bit about that as we move forward. Thanks to Ellie Terrett and Liz. And then I want to thank Paul Gray over at the Capital Allocators Roundtable podcast, and for having me on. This was a nice 30-minute segment he did with me and another hedge fund manager, long-short manager, and a commercial insurance broker. But very interesting on biotech, on Russia, on the Fed, on banks, on China tech. So it goes into a lot, and it's more drawn out because it's not on regular TV, so there's a lot more time that you can talk. I enjoy that format, so thanks to Paul Gray. Also want to thank Bansari Kamdar, Noel Randowich, and Devik Jain for including me in their article last Friday. That was the first noise about Russia. Well, I mean, there's been noise about Russia going into Ukraine for a month now, so it's not like the market doesn't know this. It's probably a sell the rumor, buy the news, either an actual attack or a pullout. My guess is a pullout, but we'll see how it plays out. The quote was, "We just have to see how it plays out over the weekend, whether or not international leadership can bring this under wraps. If not, the knock-on effects could be material, but that's what the market is worried about." Yeah, I'm going to quantify material because it's probably less of a big deal than most people think. Certainly could be knock-on effects, but I don't think it's going to move in that direction. The other thing, I Googled Hedge Fund Tips with Tom Hayes podcast this week, and I guess when I post it on Anchor, it syndicates to all these different places like Apple and Spotify and a bunch of others. But I see here on Apple Podcasts that they do reviews, and I want to thank this person a couple weeks ago put this really nice quote out, or review rather, and his name is Glass DP, January 17, 2022. The best is the title. Tom is the smartest guy in the markets right now. All right, now I'm blushing. That shares his research. Okay, that's fair. Okay, I might be the smartest guy that shares my research. Lots of supposedly smart people, but they're secretive. Tom's investments are public and free on this podcast. My big investments, not the whole portfolio. I've made stunning amounts of money following this guy. He's a great person too. Insane respect for his contributions to the investment community. That is probably the nicest review I've ever gotten, even better than the ones that my mom gave me when I was a hockey player. So, thank you very much for putting that out, Glass DP. The Varen put one out also. Been listening for 6 months. Every week, Tom provides actionable items for real results. He has a unique market perspective, so far has been spot on. So, listen to one episode and I'm hooked. Tom Hayes presented a logical analysis of today's market, brought forward informative empirical data. So this is really nice. If you're not a client for money management, which a lot of people can't because of the minimums, or in the trade service, and you want to give back in some way, nice reviews are always welcome. And then also on YouTube, and a lot of people don't leave YouTube because I embed it right into the Hedge Fund Tips website. But if you click on the video in the Hedge Fund Tips website, you'll see on top, you can do that. And like Drew B, great insights again. Congrats on passing 3,000 subscribers. Onwards and upwards. Zoo Rush, you're fantastic. Thanks for the great video. Etc. So yeah, if you are able to do that, that's always appreciated. But I really wanted to, I've never seen a compliment that nice. Literally, Glass DP, that was just made my day. Okay, moving on right along. Let's get to the audience Ask Me Anything questions. So first one comes from JT. Tom, thank you for all the effort that goes into your weekly podcast. Yeah, so you guys actually do these really nice reviews. You just do them privately on the questions, which is also appreciated. Effort that goes into your weekly podcast, which is excellent, and I hope you continue doing this as a way to help all the retail investors and develop a disciplined approach to investment management. I would appreciate your view on how to play the recovery in the auto sector given the supply chain has depleted dealer inventories to historically low levels and the OEMs are unable to meet market demand as the chip shortage and other supply chain congestion are major obstacles that are likely to continue during first half of 2022. Any lessons from the great financial crisis recovery that ring a bell given the auto sector rebounded nicely from the last severe recession and the customer is pent up and has money to spend? Thanks again, JT. Yeah, this is an unconventional one, but the auto stocks have run up a lot on, the EV narrative and all the other stuff that goes into that. So I like Intel, okay? And this comes right from investor relations. Intel CEO predicts chips will be more than 20% of premium vehicle BOM by 2030. Intel outlines plan to ramp chip production and help the automotive industry customers modernize designs to leverage leading-edge silicone. And CEO Pat Gelsinger predicts the digitization of everything will push share of semiconductors in the total new premium vehicle bill of materials to more than 20% by 2030, up more than 5 times from 4% in 2019. The total addressable market will more than double to $115 billion, approximately 11% of the entire silicon market. And Intel's building new chip manufacturing facilities in Europe and the fobs, and they just did that acquisition. Plus they have Mobileye, etc. So I think, Intel is one component that's in monster demand that is trading at a very reasonable valuation on a turnaround restructuring plan. That's a high quality company that is there's upside opportunity. It hasn't already priced in the good news that you're talking about with the Fords and the GMs of the world, which are still trading at low multiples, but a lot has to go right. I mean, these things are up 5 and 6x in a year. That's not usually, that doesn't mean it can't go up another 5 or 6, but it's not usually where I like to enter these things. So Intel, on the other hand, could give you runway, and it's a nice derivative play, and you get 2 bites in the apple. You also get reasonably valued chip exposure, which is a good thing. All right, moving right along. Mikhail Bobkov. Hi, Tom. Big thanks as always for making your podcast. I look forward to hearing them every week. I especially enjoy hearing your analysis and contrarian view on your high conviction plays over the years, from Wells Fargo to Exxon to Alibaba to Biotech right now. What's your opinion on Texas Instruments? It seems to be a bit of a forgotten stock among the semiconductors, trading at a low forward PE of 18. It traded like this last time in 2018, and it did not trade this cheaply in the crash of 2020. They have good track record of growing earnings and free cash flow, and using their free cash flow to increase dividend and share repurchases over the years. It's a good stock to hold forever. Also would like to know your general thoughts on Meta, PayPal, Netflix. Now that they've all dropped a lot recently, Meta is especially trading very cheaply. Thank you, and I look forward to hearing your opinion, not advice. Best regards, Mikkel. That is correct. This is all opinion, not advice. I don't know what your financial situation is. I deal with accredited investors. Click on terms at hedgefundtips.com. Okay, so the common narrative for the semiconductor chips right now is that this is secular because of the demand from things like cars and Internet of Things, etc. Historically, the chip business was nearly as cyclical as the oil business or the steel business, and it just ran in cycles. There's no question that this is a chart of Taiwan Semiconductor here. There's no question that Taiwan is kind of semiconductors best in class, and it generates a ton of cash. And I mean, let's just take a look here. and it has a moat. All right, so let's just pull up some data here on Taiwan Semi, and I think you're going to see that what he's saying bears out correctly. You know, if you look at the revenue per share, it's grown from 2 to 10. Dividends per share, they continue to increase the dividends. Free cash flow, they continue to increase that. It's down a little bit in the last month. Their margins are growing. That's amazing. I mean, Intel's coming for them, by the way, with the high-end chips and everything else. Their return on equity is strong, above market return on equity. They're consistently and growing. Their return on invested capital is above market. I mean, what's not to love here, other than the fact that it's run up so much? Let's just see what are next year's earnings. I mean, it looks like a lot like the way Amazon is trading, just from a market's perspective. TSM. Okay, so is this thing not letting me? I don't know. This thing's not working. Okay, so Yahoo's not working right now. All right, so is it an everything stock? I mean, look, if I want semi exposure right now, you know, we're in an environment that, you know, rates are going to modestly increase, which brings the value of future cash flows down. I want to kind of deal with more special situations where a lot of bad news is priced in and they can only go up. Taiwan Semiconductor, like, if they keep growing like this, the stock is cheap. There's no question about it. But the increased rates will bring the multiple down. $4. If this is correct, let me see. If that's correct, $4, then you're looking at a 25 times multiple versus a 18 times multiple. And that's a little rich in this environment, even though they're growing. They're compounding capital at that rate, and it's a low peg. I mean, look, nothing is a set and forget forever, other than maybe the S&P if you're hedged by. So, okay, that's trailing. Okay, for some reason. All right, so I would say I'd rather have Intel here, just because although the narrative is that this is going to be a secular cycle for chips, I think you could get a glut coming out of this when all is said and done. So it's going to 630. 6 times 2 is 12. Yeah, you're right. It's 18 times. 160 price target. I mean, this thing is probably okay. I mean, I can't find any flaws, but I just like a larger margin of safety. But this is a higher quality business than Intel is right now. The idea is that a few years out, Intel is going to be this type of business, and you're saying, why not just buy this business now? This looks exactly like Amazon, by the way, which Dan Loeb came out with and said, look, it's trading exactly the same way. Came out and said that there's $1 trillion of unlocked value because of the cloud. They should be broken up, et cetera, et cetera. I tend to agree. So I can't find anything wrong with it. I'm not owning it. I'd rather buy more Intel at these levels, to be honest with you. But good question, Mikhail. Thanks for sending it in. Roy Rogers, hi Tom, need some advice here. I'm structurally bullish on oil in the long term, especially the drill bits and equipment. My thinking is that an increase in energy prices will shift the SRAS, which is the short-run aggregate supply, to the left, reducing output and increasing prices. Therefore, if aggregate demand does not change, the central bank has no other choice to get more ink for the printing press, higher money supply. Slack in the economy. Well, I don't know that I agree with that statement, but Okay, slack in the economy put downward pressure on input prices, shifting SRAS back. In other words, in order for Brazil to have a stronger bullish lens, needs a weaker dollar. Well, I think you're going to get a weaker dollar. I know that's non-consensus right now, but I stand by that. I said, 6 months out at the end of last year, we're likely to see a weaker versus a stronger dollar, and I think that's going to play out. Since it's commodity driven, trying to find a bearish thesis indefinitely is a stronger dollar. Someone is selling Stone Hard. That's the one that he brought up last week. I haven't pulled the trigger on it yet. It may be my market psychology Howard Marks alludes to. Thanks again for the insight, Roy. So I reached out to investor relations after the podcast last week, and after I found the short thesis. So the short thesis was something put out here on October 27th from Viceroy Research. They put these things out. They short the stock. Hopefully they don't cover. That would be illegal. There are investigations into that. But they put these out. And basically, there was after a raid by the FBI in conjunction with the Department of Homeland Security on PAC's Global Technologies Florida offices, we have found serious concern for the operational integrity of both PagSeguro, which is a Brazilian payment processor, and StoneCo, which is a Brazilian payment processor. We've been keeping an eye on the two companies for some time, but the recent developments have prompted us to publish this brief note. Both PAGS and StoneCo are dependent on the Chinese company PAC's Global Technology Limited for the POS terminals. Yesterday, PAC's technology locations were raided by the FBI sources, reporting that the machines have been used as malware droppers in command and control locations. We expect PAGS to be subject to significant regulatory action and scrutiny, with the clear possibility of legal action against the company by various counterparties, et cetera, et cetera, et cetera. So the stock collapsed in concert with this report. The problem is that they don't do much business in the U.S. So I emailed them and said, hey, is there any merit to this report? I sent them the short report. And what impact, if any, will it have on your business in Brazil? I'm trying to understand any downside before building a material position in your company. Please call or email with any thoughts. So they emailed back and they said, hi, Thomas. We did not identify any data leakage in any terminal. We currently count on 6 point-of-sale hardware suppliers, which I thought, like, what idiot company would have one point-of-sale supplier to enable our offline clients to accept electronic payments, with PAX being one of those 6. So basically, the stock's down 90 some odd percent, and it's 1/6 of the business maximum. The PAX POS used in our operations run on our proprietary software application. It's used in our operations run on our proprietary software applications for payments. Those applications are homologated by the main card schemes in Brazil. All POS software used in our operations is PCI certified. Stone has been diversifying its POS supplier base. For instance, we are no longer purchasing new POS devices from PAX for our SMB solution for a few months, with PAX still being a relevant supplier of new terminals for our micro merchant solution, TON. StoneCo is compliant with Sarbanes-Oxley and Brazilian central bank standards. So I guess that was also part of the thesis. I said, at these levels, why aren't you buying back a ton of stock? They have a $200 million buyback authorization from last year. I'm not sure why they haven't added more. They probably haven't used it up. But right now, they're in a blackout period, which is why I had this Yahoo Finance up. I think they report in early March. STNE. So the question is, Buffett always says that great opportunities come around when high-quality businesses are surrounded by unusual circumstances. This is an unusual circumstance. The question is whether or not this is a high-quality business. I love the pain, but this is trading like it's going bankrupt, and it's a complex business to understand, because whenever you're dealing with consumer credit, there's all kinds of risks that are very hard to understand. So my inclination is to put this in the too hard pile, but I'd also be very comfortable having a small position in it, and just to watch it and then build as I see things happen. So that's kind of my takeaway. It's kind of too cheap to ignore, but have to keep drilling down to find out, why is this thing going bankrupt, or why do people believe this is going bankrupt, and why is it not the case? And I think that part of the reason this stock is down is not really relevant what the FBI does in the U.S. regarding some Chinese terminals that no one really cares about. So this may prove to be interesting. I'll have a little flyer on it and do more research. I had Carter take a look at it. But this is a hairy one, and this should go in the too hard box, but it's so cheap that it's worth pursuing. So I know you haven't gotten anything back to me on your research. Why don't you do that, and then we can explore it further in coming weeks. Rich C, listen to your podcast. Very good analysis on Baba. Agree on all points. One question I haven't heard you address is the risk around the VIE ADR structure. As I understand it, the VIE structure is technically illegal in China. If the CCP chose to enforce that policy, what would happen to the ADRs held by the U.S. shareholders? I realize the structure has existed for some time, but the CCP has shifted dramatically in the last 12 months on a number of long-term policies and practices, not overly concerned about the other regulatory threats, i.e. the need for their auditors to be subject to PCAOB inspection, but the ability for the CCP to pull the rug out of this structure unilaterally is concerning. Appreciate your thoughts. So, first off, welcome, Rich. You're obviously a new viewer. We have covered this a lot in the past. So we own we shifted to, so the US ADRs, the BABA, are fungible to the Hong Kong shares 9988. We shifted over. You can just shift at any time, actually. There was no real reason to do it at any one time, but we just wanted to focus on the business and not worry about all the noise that was at a crescendo about a month ago regarding this issue. So we own the Hong Kong shares, which are technically safer than the U.S. shares. But Charlie Munger was out yesterday talking about it, and he owns the U.S. shares, the BABA. And they're just fine. They're interchangeable. You don't lose any value. It's an exchange, I think 11-1 or something like that. And we can shift back at any time for a nominal change. So if you're worried about that, just own the Hong Kong shares. We have some derivatives on the U.S. shares, so we're not terribly concerned about that. But good question, and that's how you alleviate that issue. Okay, Roy. Excellent game throughout. Okay, I guess he's referring to the Super Bowl. I suppose a learning lesson from the game was that we get one chance, maybe in 3 to 4 chances in the third and fourth. Need to capitalize. Stick with the Mungerism, patience, decisiveness, preparation, discipline. What are your thoughts on SRAD? You asked me about this one, and his thesis here is that a famous pension plan is invested. So the pension plan is the Canadian pension plan. They own 90% of this stock, which seems like a lot. It's only 1%, 1.8% of their total assets outstanding that they report. I don't like this type of stock because so Canadian pension plan. By the way, they are the last reason you should be investing in this stock. They are historically not great stock pickers. They don't. I wouldn't go so far to say that they would be a contraindicator, but it's something to keep in mind. And none of these other names are terribly overweight the name, with the exception of these two. And these two I'm not familiar with. And if they were great stock pickers, I would know them and I'd be a lot more interested. That said, it doesn't preclude us from taking a look at it. My issue is, and I've said this on past podcasts, I generally don't play with companies that don't have a meaningful history of financial information. So I've only got 2 years here of financial data, and that's really not enough for me to understand how management operates through ups and downs and how the business operates through cycles. So, it's got a crappy return on equity, very high gross margins. They supply software to all the gamers, which is kind of what's interesting about it, is that they're not one of the online gamblers because that area is getting saturated. They are a picks and shovels for that, which is interesting. So it warrants more research, but for me, it goes in the too hard box because I don't have enough data to analyze. I haven't seen the trend of the business. People can get rich on doing IPOs. It's not my game. I like more established businesses, and when they get out of favor, I get to buy a high quality business at a discount due to unusual circumstances. That's my thing. So I'm a pass, not because I don't like the business, but because I don't have enough information to make a good decision other than guessing and gambling because the IPO is down. Maybe I'm getting it cheaper than the people who bought it at the initial offering. Who cares? That doesn't help. So if you want to send more detailed research that I could take a look at, I'd be happy to do that, but we're not going to spend time on it in our shop. So Brady, Tadaro, Tom, you've recently been trimming your energy position. Do you feel companies that engage in energy infrastructure, logistical assets, and distribution of fuel service like MPLX could be a good play within the current state of oil prices and possible geopolitical conflict in Eastern Europe? Second question, what will it take for Wynn Resorts to distribute a dividend again? Number one, I don't want a dividend from Wynn. I want them to grow in Macau. And what's going to take for that to happen is for Omicron to die down. Hong Kong is testing every one of its citizens this week. So they're on top of it quickly. The pent-up demand is serious, and it's going to explode to the upside as that once it's opened. And it's just a longer waiting game than expected because they've had the zero COVID policy. But we're going to talk about that because they just approved the Pfizer COVID pill, which tells us that they might be more inclined to drop their zero COVID policy. Otherwise, why would you need a COVID pill effectively? So because that pill's designed to let everyone go back to work. If you get it, then just take the pill, and in a couple days you're feeling better, Tamiflu and that type of thing. So that's the answer on Wynn. On the midstream companies, we own Energy Transfer, so yeah, we like the midstreams better here. If you have to put money to work in energy today, I like the servicers because the demand, the rig count's going to continue to go up now that prices are high, and I like some of the midstream Energy Transfer, MPLX. Let me see. This has moved quite a bit. So if you're just buying the dividend, I wouldn't be inclined. We were buyers of all this stuff in the fall, and the midstreams have not moved nearly as much as the EOPs, exploration and production. In the short term, well, anyway, later in the call, we're going to go through the one of our metrics on the energy sector and why we think in the short term that it's overdone. But I just don't understand at this stage why everyone is so eager. Please give me one energy name that you would still buy. Why are you trying to catch the quarter in front of the steamroller? Why would you want to pick that up when you could buy Chinese tech with a moat that no one wants? You can get them for, a third of their intrinsic value. Same with some of the biotech. If you can't handle the volatility and you want to buy something that's up, but that's not this game. Look, there are people that trade small accounts and make good returns buying breakouts and that type of thing, but they never have any money under management. So they trade their personal account and they make a couple $1,000,000 a year and they're happy, and they give half to the government because it's all ordinary income. And there are very few of them that can do that well, but there are some. You have to find a style that fits your personality. We buy things that are out of favor so we can lean in size, that have a margin of safety, and then we wait. We sit through the volatility. If it moves against us, we add more. And then when it gets to double or triple, when everyone else wants it, we help them out and we lay it off. It's not complicated. We sell to those people buying the breakout. They get the last nickel or dime in front of the steamroller, and we got the 90 cents. So that's how we think about it. But anyway, I think that's a great question, because if we were forced to put new money into energy, we definitely still consider the servicers as the rig count goes up, and some of the midstream maybe, but the E&P I think are due for a pullback here. And whatever will be the catalyst, whether it's Russia, whether it's Iran, makes no difference. That's how it's set up. It's sucking in the last marginal buyers, and then it'll just flush them out, and the trapdoor will open, whether it's 2 days from now or 2 months from now. That's how we see it in the short term. And when we may very well use that opportunity to load back up if it's a material enough drop. But that's where we're thinking about it for now. I can't find the question. Someone asked me about, I don't know where the question went. It must have gone together. But someone asked about, PayPal and Netflix and Facebook, given the huge precipitous drop and our thoughts on tech of late. And I'm sorry I'm not getting your name right here. We just got a lot of questions. But anyway, at least I'll get the substance of your question right. Thanks for sending that out. And the answer is, PayPal's now at 25 times. It's going to grow at about that pace. I think PayPal is cheap enough here. It's worth to start to nibble, and especially as you see the thesis that I'm going to cover as far as tech. Everyone's dumped tech. Overweight exposure is now at below 2008 levels, and that was the beginning of a huge move. Facebook's trading at 16 times. I said last week, I think anywhere between 180 and 220 this range, if you can slowly build a position, I think it starts to make sense. It's too cheap. Mark Zuckerberg he's a moneymaker. He's not going to keep spending on Meta if he can't get a return. They were buying back a lot of stock at 320. I don't think that's a reason. I don't think they felt the stock was cheap at 320. I think that in part, the sad part about it is Mark was selling into that. So they were probably actually creating liquidity for Mark, which is a little disgusting. But leaving that aside, they do have a lot of cash to buy back stock. And I think at these levels, we could see them step in. And I think these start to get attractive. People have left him for dead. I think that Dan Loeb is now topping up on Amazon. So you're seeing Facebook, Amazon. These are the ones that have underperformed. PayPal. Some of these are getting attractive at these levels. And you don't want to lean in all at once because they're still falling knives. But starting to build a position and paying attention to them, I think the tide is going to shift. I think, with 6+ rate hikes already priced into the short end of the curve, I don't think we're going to get 6. Certainly not in this year for sure. And I think anything less, the worst case scenario is kind of priced into the bond market. I think anything less than that, these things just start to rip, biotech included, and some of these high quality techs. I still think you stay away from the high price to sales. It's interesting. Kathy Wood was on CNBC halftime today for about an hour. Her portfolio is down 57% or 54% in the last 12 months. And she was defending her ideas. And I just threw her top 40 stocks into kind of a charting service that I use, stock charts, and just to look at them all really quickly. And it's interesting because they all looked like they were bottoming, areas where, just on a technical basis, not knowing anything, I'd be like, oh, that looks like it's overdone. That looks like it's overdone. So it looks like she's set up for a bounce. And then I went through 20 of them. And I couldn't get my arms around buying any of them. I mean, even with their fast revenue growth rate. There was one that had $74 million in sales and was trading at $5 billion. Every single one of them were trading at 10 to 20 times sales. Now, I'm taking the under on rates, but in a rising rate environment, The real issue is, I think that she is correct about some of these technologies will revolutionize the world. There's no question about it. But the risk is, because so few of these are earning money, they're not generating positive cash flow, is that as the cost of capital increases, even modestly, it's going to be very hard for them to continue to raise money to fund their dream, to fund that future. So in other words, their process may be correct and they may get stopped out and blow up their account, so to speak, in that they can't continue to raise capital the same way they could when money was free and there was somewhat of a misallocation. So out of the 40 I went through, there was only one that I could get comfortable around the valuation and the whole thing, NVTA. And it's not something I would even lean into, but it's interesting. But we already have enough biotech exposure. So this was the only one that made any sense to me from a valuation. It's not to say that her whole thing can't bounce and work. And I think that when all is said and done, there will be some success. So in other words, even if half the portfolio that she currently has goes bankrupt because they can't raise capital, there will be enough in the other half of the portfolio that are up, 3x, 5x, 10x to pick up the slack. The question is what are the timing of the losers versus the winners? And that's a risky game and there's no precedent for it. So you have to be right. And, So that was my big takeaway, but I hope she does extremely well. She has done extremely well historically. I met her in Florida over the summer. Extremely nice lady. She has a house, a town over here in Connecticut. I like, the thing that I like about her style is a lot of people that have these kind of high multiple strategies, they're always buying the top, and at least she buys these stocks when they're broken down, which I think is more interesting. She likes to buy them when they're down 50 and 60%. So that may be what sets her apart, and 3 to 5 years out, everything that she says comes true, and she is able to get that compound annual growth rate, but very, very hard to predict, but I wouldn't bet against her. But I just couldn't get comfortable. It's a different style, different strokes for different folks. I just couldn't get comfortable with belief over metrics. But there's a lot of money made that way. So, the difference, you think about Amazon that was down 90% in 2001. And to answer the question from the other guy about SRAD, in 2021, I think Amazon IPO'd in 2001. I think Amazon IPO'd in 1994. So you had 7 years of financial data when the stock was down 90% that you could say, wait a second, their return on capital is fine. They're still growing the top line consistently in line with their historic trend despite the recession. The fundamentals of the business are improving on every metric, and you could step in because you had that historic data. These companies that are like a year and 2 years public, it's higher risk is what I'm saying. So here's an article from Andrew Barry. I love the whole story here about, he's basically making the case. It's trading at 16 times. It's the cheapest multiple it's ever been at. They were buying back shares. So I think, the PayPal, the Netflix, the Amazon, the Meta, I think you can start to nibble, and you'll probably get more chances to buy them in coming weeks with volatility, into that first rate hike. And then we're going to see some data in the article of the week that shows that tech has a tendency to outperform after the first rate hike, which no market participant is positioned for, and is going to be very surprised by, I think, moving forward. So what I loved about this Dan Loeb thesis on Amazon sees roughly $1 trillion of untapped value is he's saying split up the AWS and run that separately. The same thing could happen with Alibaba. The growth rate of AliCloud is growing faster than AWS. That could be another way that Alibaba winds up unlocking value and maybe creates a smaller footprint in the eyes of the Chinese Communist government. Then you have Alipay, you have AliCloud, and you have Alibaba. Those three parts, and you start to add them up, and people start to see the discrete values, and that's how you could get up to $300-400 very quick. I'm not saying that's going to happen, but it's a great parallel to what Dan Loeb's talking about with Amazon here in the U.S. So moving on to Alibaba, Jack Denton wrote a great article about earnings coming up on Thursday, February 24th for Alibaba. So, and he talks about the wild ride. Obviously, the Chinese consumer has been very weak. In the China National Bureau of Statistics reported slowing retail sales growth of consumer goods in October and November. Investment banking firm Benchmark also showed December may have been weak. So the consumer is going to be weak. The market should know that. But I think that's the last final hurdle we have to get over. It could be a catalyst to the upside. But the key 4 metrics that he's pointing out to look for is gross merchandise volume. We want to see analysts expect GMV to come in near $403 billion. It's most ever and 10% more than the same quarter a year ago. Customer management revenue, CMR, made up 36% of Alibaba's total sales in its most recent quarter. CMR comes from services like marketing on Alibaba's platform and is expected to slow if merchants trim their budgets. The company reported $11.1 billion in CMR in the September quarter, so that's the second number to watch. The third is international commerce. This is a huge part of the growth story, represents a growing segment for Alibaba and one that analysts at Goldman Sachs and others are bullish on. Expectations are for $2.5 billion in revenue from international sales, up 6% from the September quarter and 16% higher than a year ago. I mean, this is amazing when you think about up 16% in the face of all of these regulatory issues. And then cloud computing is the fourth number to watch. Increasingly important segment for Alibaba. When it last reported quarter results, cloud revenues of $3.1 billion represented 33% of annual growth. Similar growth momentum in cloud would be a welcome bonus when Alibaba reports. And I think that's the name of the game. Is I think expectations are low on the retailing side because of the zero COVID policy, all the shutdowns, all the uncertainty, issues with the Olympics, etc. But if the cloud grows, I think the street's going to like that, and we'll see how that plays out. Ray Dalio's Bridgewater boosts its bets on China. In his latest 13F filing, Bridgewater Associates showed that the firm boosted the number of shares it held in Alibaba by 29% in the fourth quarter to take its holding in the Chinese internet services giant to the 8th highest spot in its portfolio. They do get my weekly notes, by the way. So, anyway, I'd like to take credit for that. But he's been in China for 40 years. He knows it. He knows it pretty well. Okay, Charlie Munger's Daily Journal scored a 15 times return on a stock and used margin debt to invest $87 million last quarter. So they finally realized a 15 times return on BYD, which is a Chinese stock that Li Lu gave to Munger a number of years ago. So they took that off and they put the money into more Alibaba and that 50 million, and then they took on another 37 million of margin debt to buy more Alibaba. And this is a guy who he and Buffett always talk about never using margin debt. Yesterday he was at the Daily Journal meeting. He's like, well, sometimes you got to use a little margin debt, and he did it to double down on his double down of Alibaba. So that tells you the level of conviction, and that's that. Next, he was asked a number of questions in the interview yesterday, but the key quote that we're going to cover right now is, in China, the companies we invest in are stronger relative to their competition and price lower. We get more strength per dollar invested. That's why we are in China. So that was a key quote on the China stuff. And here are some more quotes. Okay, so, all right, okay, so there was someone asking, could my stuff get confiscated, blah, blah, blah. So Munger says, I'm reading the transcript. We invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. Other people, including Sequoia, the leading venture capital firm in the United States, have made the same decisions we have. I am sympathetic. He's talking that Jeffrey Gundlach is nervous. So that the question was, Jeffrey Gundlach says China is uninvestable. Why are you investing all of our Daily Journal money in Alibaba? So he says, as far as Gundlach, I'm sympathetic that he's nervous. He does not have to join us. Different strokes for different folks. I cannot criticize his point of view. I just reached a different conclusion. Okay, next one. Question comes from Bill Roberts. He says, Charlie, you and Warren have been making concentrated investments since the 1950s. Many of these investments have led to gains, but more impressively, none of them have led to significant losses. As far as I can tell, neither of you have lost more than a few percentage points of equity in any single investment. Well, that's not entirely true, but close enough. It has taken an additional, you've taken an additional $49 million and margin debt to make investments. What makes you sure that these investments will not lead to a substantial impairment of Daily Journal's equity capital, which could impact the ability to invest the resources needed to operate the software business? Of course, if you invest in securities okay, so this transcript is not perfect, but if you invest in securities, the risk that they go down, you lose money instead of make it. But if you hold a depreciating currency that is losing purchasing power on balance, we prefer the risk we have to those that we are avoiding, and we do not mind a bit of margin debt. So he's referring to the extra $37 million of margin debt to buy more Alibaba. We have a lot of questions about China risk. He's interested in your take on China and Chinese exposure for the long term. Could be banned from doing the business, blah, blah, blah. Okay. Considering the risk, why would anyone as smart as Munger or Buffett consider investing in China or China's companies? So the questioner had all the litany of the VIE structure, the communist government shutting things down, et cetera, et cetera. So Munger's response was, in China, the companies we invest in are stronger relative to the competition and priced lower. That's why we are in China. Then another one about the communist government. He said, the Chinese government is worrying all of the capitalists in the world more than it used to. And of course, we do not like that. We wish that China and the United States got along better. And if you stop and think about it, both China and the United States have a lot, I guess, to lose if the existing tensions arise. What bad is ever going to happen to China or the United States if we are close? Make good friends out of the Chinese, vice versa. Who is ever going to bother us? Of course, we should make friends with China. Get along with people who have a different system of government. Okay, so those are the basic key points from Munger's interview yesterday. We posted the link in the article of the week. Now some headlines on China. PBOC pumped more liquidity into the market this week, spurring gains in China stocks. They added another $15.7 billion into the banking system with their medium-term lending facility while leaving the borrowing rate unchanged. So they're going to continue to do this into the China National Congress. And given the domestic turbulence now, and we're going to cover a couple of those things, he really has to do it because that third term is no longer a guaranteed thing. There's rising disillusionment among the populace with the way things have gone since they cracked down. It always comes down to money. You screw people's job prospects through whether it's zero COVID policy, shutting down an industry of hundreds of thousands of jobs, the slowing down the economy and housing, and people get upset, they start complaining, and they look for faults because they want relief, and the relief is not coming from you, so they look to get it from someone else, and that's a huge risk between now and November for Xi, and he knows it, and he's got to juice things back up. He overshot to the downside last summer. So China tech stocks outlook improves a year after the $1.5 trillion rout. Some indicators suggest Chinese tech names are good to buy now. Tech rally started to fall apart in February of 2021 on the crackdown. Let's see here. Okay, Hang Seng Tech Index is trading at historically low valuation. We know all that. You can see it here. The key thing here was the earnings forecast for Hang Seng Tech Index. The 12-month earning estimates have really started to jump since November. They're up about 12% actually since early September. So, while you see the S&P 500 slowly climbing to 224, you see Hong Kong Tech, they're ripping higher. So the worst of it, analysts are saying it's going to get better and better towards the back half of the year. And provided Baba's guidance is reasonable and their cloud business was strong, I think the market's going to like it on the 24th. So, but those are the earnings. Starting to see some inflows, short interest dropping. So that's more good news. Next, tech giants push toward an $8 trillion metaverse opportunity, one that will be highly regulated. Tencent and Alibaba and ByteDance are going to be among the anointed few by the Chinese government that pushes the metaverse. That's a positive thing that increases Alibaba's moat. From Credit Suisse to Goldman Sachs, investment banks say it's time to buy Chinese stocks. More international investment analysis says it's time to buy Chinese stocks. Bernstein and Goldman Sachs have released thick reports on the investability of Chinese shares. Credit Suisse upgraded China to overweight, reversing a downgrade of stocks about 12 months ago. They expect regulatory uncertainties to subside after a national parliamentary meeting in March and remain muted at least until after the Chinese Communist Party National Congress in the fourth quarter. So there's a national parliamentary meeting in March, so they'll get rid of any remaining regulatory uncertainty. They'll keep things quiet, juice everything up into November, and then after that, if they want to crack down again, they may do that. Bernstein says China is uninvestable no more. 172-page report entitled China's Equities Uninvestable No More. We believe there's case to add back China exposure to global portfolios for 6 key reasons. Pointed to expectations for growth in new financing, easier monetary policy, more attractive stock valuations relative to the rest of the world, rare opportunity to pick stocks, growing foreign inflows, and increased earnings. HSBC, investors too bearish on China. Stronger USD is not good news for China's stock markets. That's going to change in my view, but that's not well known. That's well known and priced in. Even good blue chip stocks are now trading at attractive valuations. Goldman valuations remain below the Wall Street's target of 14.5% price to earnings ratio. They're at about 12. 89-page report Goldman put out on Sunday, why China A shares have become more investable for global investors. And then UBS from underweight to overweight, that's a big upgrade, and so on. So sentiment is turning. That's good. That'll get institutional flows coming in. As that comes in, opinion will follow trend. Here's China's approval of the Pfizer pill, opens the door for ending COVID-0. Surprise nod makes Paxlovid its first Western COVID medicine. Experts suggest the move may presage action on reopening versus doing this zero COVID shutdown cities and crush consumer confidence and consumer sentiment. Chinese graduates opt for gig work as job outlook worsens. This is a function of the crackdown on a lagged effect. We said this was going to happen. It's happened, and the natives are getting restless. So that's that. The other thing, China's anti-graft show is educational with unintended lessons. A documentary created to celebrate the success of Chinese anti-corruption campaign instead has aired the dirty laundry of the Chinese Communist Party. There are like 140-page internal political documents of showing unease with President Xi going into that China National Congress. So he's going to do, the number one job of any one politician is to get reelected. He's going to do everything he possibly can before November to juice this thing back up. And with Alibaba's weight, they're going to be a major beneficiary in our view. Why some Chinese are lying flat and what that means. So because of the slowdown, Chinese are making it harder for strivers to get ahead. Some have decided to drop out of the rat race entirely, spawning a movement known as lie flat. Its adherents are tired of the stress that comes from working long hours and the family and societal pressures to keep climbing the ladder. Some see the phenomenon as a warning of an impending Japanese-style stagnation. Others argue it's akin to the 1960s counterculture movements, with young people seeking a less demanding society that's more focused on personal development. Why is this happening? The 996, 9 a.m. to 9 p.m., 6 days a week, et cetera, et cetera, et cetera. But this puts Xi Jinping in a box again. He's got to create jobs. He's got to juice the economy. And the best way to do that is with your national treasures, which are Alibaba, JD, and Tencent. China's biggest chip maker, SMIC, posts record revenue despite U.S. sanctions. That came out this week. That's great to see because Alibaba has their new chip in the cloud segment, and that tells me that the enterprise spending is looking good, and that could be very positive for Alibaba's earnings on the cloud and chip side, which would be really, really good. Hong Kong stocks climb as China eases on China easing bets, meaning they're going to have more accommodative policy moving forward, which we agree with. And it goes into some of that. This is the paper owned by Alibaba called the South China Morning Post. And then Alibaba, this is very interesting. Alibaba, this came out today, and it was up like $3 this morning when the market was down modestly, traded up to 129.40 on the US ADR, and then the whole market rolled over on this Russian noise, and I don't know where it's closing. It's 4:30 now. Okay, so I'll see where it closed. The point is that Alibaba is said to launch direct online retail model to complement Taobao, Tmall platforms amid increased competition, weak consumer spending. The new app will be launched via Tmall, will establish an online retail model in which Alibaba will directly source, buy, store, and market goods. A number of consumer electronic brands have already started talks with Alibaba ahead of this launch. This is a direct shot across the bow at JD, so it wants to take some of JD's share in this particular vertical. And since they did the restructuring, making managers of all the different divisions, now they can do these things more nimbly without all the bureaucracy at the top. I think that's going to be a very positive thing, and the market liked it this morning. I'm sure the market liked Charlie Munger's comments. The fact he took out margin debt to buy more Alibaba was also a vote of confidence. When will the China be the world's biggest economy? Maybe never. This speaks to my thoughts that I've been sharing in recent weeks about their population headwind. I do think they're going to have one last big run up here, but everyone worried about them being the largest economy in the world. I think it's premature. And the reason is right here, the China population demographics. By 2050, the China population is expected to drop from 935 million to somewhere between 671 million to 769 million. They're an aging population. The exact same thing happened to Japan. The tell for this will be in their last hurrah when they start making bids on Rockefeller Center and some of the trophy properties in the U.S. And everyone says they're going to take over our country. That should be the last breath before they go into a lost decade or two like Japan did. But in the meantime, I think they've got one huge run left in them based on if you overlay the Japanese demographics before they rolled over and the Chinese demographics before they're going to roll over, we've got a few more years. And the parabolic moves always happen in the last few years. So that's that. Now, U.S. amps up Ukraine warnings as Russia says no invasion planned. This is an odd scenario because 48 hours ago, it seemed like this thing was behind us. And by the way, if you're on the podcast, you're going to get cut off. We have a lot more important stuff to cover this week. I don't know why there was so much content. I guess we had a lot of questions this week. So just go to hedgefundtips.com, scroll down to the VideoCast. You'll see a YouTube video. Fast forward to minute 60. You will pick up word for word where you left off, and you'll be able to see the last 20 minutes where we get into the article of the week, which is the most important part. So so it looked like that was over. And then the U.S. is coming out saying, like, the minute Russia says, okay, we're basically going to pull back, U.S. comes out and says, no, they're not pulling back. They're attacking. And it's odd. I mean, there are satellite images, so there's some objective reality to all this. But they haven't attacked, and they could have attacked. Tells me that they're inclined. We will see. But this guy, Mark Newton, he works for Tom Lee. He's a technical analyst, and he put out this quote, and it's kind of what I've been thinking in the back of my mind. But he verbalized it, and whether it's true or not, it's worth a plausible consideration. He says, overhyping the Ukraine situation takes the attention away from the ongoing domestic issues, like inflation, like high gas prices. One could actually argue the administration wants a situation like this. Wartime decisiveness bolsters approval ratings when approval has been plummeting, and most of Europe aligned with the U.S. equals no worry. And then Tom replied to his employee, sort of makes sense, and markets are getting very worried for the wrong reasons. So we'll see how this plays out, but that is what it is. If you look back at history, these things actually aren't a big deal. This we posted last week from Ryan Dietrich at LPL. U.S. pulling out of Afghanistan, the Iranian general killed in an airstrike, the Saudi Aramco drone strike, the North Korea missile crisis, all these things over the last 20 years, bombing of Syria, Boston Marathon bombings, London subway bombing, U.S. terrorist attacks, Iraqi invasion of Kuwait, even the Iraqi invasion of Kuwait, Reagan shooting, Yom Kippur War, Munich Olympics, Six-Day War, Gulf of Tonkin. So basically Pearl Harbor attack. It goes through the total drawdowns. The one-day drawdown, if they attack tomorrow, on average was 1.1%. The total drawdown on average was 4.6%, but we've kind of priced a lot of that in. We're down 6 or 7%. We were down 9% at the worst a couple of weeks ago. And on average, it takes 19 days to recover if it goes in that direction, which I think is a low probability. Now, I think a better analog is the last time that President Biden was in power. When something like this happened, he was the vice president under Obama. And in February of March of 2014, Russia annexed Crimea. And you can see the S&P was down about 7%. And it wound up finishing for the year up 13.69. We're already down 7%. This Russia thing has been known for a month and a half. And this might be an interesting analog to follow. We're kind of already there. So whether we get them finally attack and Ukraine surrenders, or Ukraine withdraws its application to NATO and the thing ends tomorrow, my guess is we're going to have a similar type of outcome here into the end of the year. High single digits, low double digits, which we've said since last year. Okay, here's Buffett. I guess Munger is listening to his advice. Opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. That's what Munger is doing at Daily Journal. He's even going beyond the bucket and borrowing a bucket to catch the gold. Quote of the day: the most important quality for an investor is temperament, not intellect. It's dealing with the volatility. Munger started his position on Alibaba in Q1 of 2021. So that was at this, the low 200s, low to mid 200s. And then he did nothing the next quarter. It dropped. He doubled down. It dropped again. He doubled down on his double down. And it seems to be putting in a bottom. Closed today at around 125, 124 and change. So that's that. Moving along. Rebecca Patterson on Global Macro Investing. She was on the Masters in Business podcast on Bloomberg this past week. It's well worth a listen. She is Director of Investment Research at Bridgewater. And what she spoke about towards the second half is something that I've been thinking a lot about and talked about on TV this week, is using the Fed balance sheet to re-steepen the curve while at the same time being more measured in how quickly you raise the short end of the curve. So we'll talk about that in just a minute, but that's worth a listen. If you didn't get to watch Carl Icahn's documentary on HBO, I would suggest it. It's called The Lone Wolf of Wall Street. I thought it was fantastic. And then moving right along to some... Okay, this clip that I was going to cover is about the supply chain. Basically, the guy that runs the LA port says the worst is in the rearview mirror. Things are getting a lot better. So that should also help inflation prints moving forward, as well as demand shifting from goods to services as travel reopens, etc. This is what could drive the Fed to a plan B for balance sheet reduction. It talks about the composition of the balance sheet. 2.5 trillion of the 9 trillion is short-term treasuries. So that's not going to help with my thesis of rolling off the balance sheet to steepen the curve. But that said, another 3 trillion is on the longer end of the curve. So if they started with the long end of the curve, getting rid of that, that's going to create supply. Now, most people say, well, when they start selling bonds, yields are going to go crazy. The 10-year yield's going to be over 3.5%. I don't think so, because I think there's a monster amount of demand in the carry trade, meaning you could borrow in yen for basically nothing and get still effectively nothing and get, let's call it 2 to 2.5% on the 10-year yield. It's free money. So you're going to see a monster amount of demand now that yields are going up for U.S. Treasuries, and that's going to keep them contained, hopefully into 2 to 250. And if they don't move too aggressively, let's say they do 3 hikes this year, 3 or 4, you're still going to have a spread, probably 75 bips or 100 bips if we re-steepen, and that incentivizes banks to continue lending. So that's that. Kashkari came out, let's not overdo it on the Fed rate hikes. I agree with him, but you can use the balance sheet. We've had a lot of tightening. The budget deficits come in, the 210 spread has come in, that's tightening, that contracts credit. The short end of the curve has priced in about 6 hikes already. That's tightening. So they don't have to be, the market's done a lot for them. They should do 25 bips a meeting, and then slowly and surely see how the market responds. And originally, both the market and myself were very concerned about the idea of starting the balance sheet roll-off close to the time that they are starting the rate hikes. And I've changed my view on that because the biggest threat to this recovery is the yield curve inversion. So we've got to keep the difference between the short end of the curve and the long end of the curve as wide as possible. The wider it is, the more credit will be extended by the banks, the longer the recovery will continue. The narrower it is, the lower the incentive between what they pay for capital and what they earn on capital. So I think the way to do it, I think Kashkari's right. You do the 25 bips slowly but surely, keep the short end of the curve subdued, and then you start to sell off the long end of the curve from the balance sheet, create some supply. It'll be absorbed by the foreign buyers, but it'll still keep the spread wide and will continue to be off the races. So that's how you orchestrate a soft landing, and hopefully they'll follow through and have that level of creative thinking to do it in that way, and monitor it. Okay, global investors snap up Chinese stocks. Okay, that one should have been before. Biotech stocks. So sentiment starting to come around on biotech. And this lady or this man Josh Nathan Kazis is highlighting 8 stocks that are trading at a discount to cash. That's how cheap the market is. They're over 100, by the way. And so he's pointing to how extreme the sentiment has gone on the downside. And then there's another article here in Business Insider, biotech stocks to buy. Experts at top tech-focused fund reveal 3 companies set to surge on drug recovery breakthroughs. But what they're really saying, they're really making a case here that the sector has gotten overdone, and his thesis is that while COVID may continue to dominate the news agenda this year, we're confident that 2022 will usher in the end of the pandemic. We're hopeful that the Omicron variant will raise immunity throughout the world with a corresponding rise in severe symptoms. Without a corresponding rise in severe symptoms, increase global resilience to the virus in combination with ongoing vaccination programs delivered by the biotech sector should lead to a reduction in COVID-related. Okay. Said this would act as a boon to biotechnology space as companies would benefit from the resumption of standard medical activities. That's the key. Resumption of standard medical activities, increased face-to-face interaction should also permit greater deal execution in the sector. So they're making the case for M&A rebound that we talked about last week and all the cash on the balance sheets of pharma. And they're focused on the oncology space. There are a lot of imminent breakthroughs. They point out Mirati, Gilead, and Intelia. And that's it. So they're talking about the pipeline and how these pharma companies are going to have to buy their innovation and they have the cash, et cetera. All the cases that we made a week and 2 weeks ago. Boeing's China 737 MAX completion center ready to for delivery restart. This was from Flight Global. This is a Singapore industry paper. So they're just basically waiting for that liftoff, which is the next catalyst. I thought it was interesting. This week there was an insider, not this week, but I think today. Let me see. I sent it for them to post on the site. Insider. Yeah. Lawrence Kellner, I think he's a director. Yeah, he's a director. He bought $1 million of shares on Valentine's Day, so 3 days ago. So that's that. We already covered the PayPal. They've been buying up a lot of stock down here. And where's the article of the week? Okay, this is the bullish percent indicator, by the way. We did this today. And it just shows, again, when this indicator gets extreme, you usually get a short-term correction. This is the XLE below. Elevated here, rolled back over. Elevated here, it moderated and rolled over. Was weak for the rest of the year after a huge rally. And again, got elevated here, moderated, and it's elevated again and rolling over when everyone's euphorically buying it. I think we'll get some further weakness here after this Russia thing is worked through. So, so thanks to Liz and Ellie for having me on. Here were my notes ahead of yesterday. So Liz asked, which is the bigger threat, Putin or Jay Powell? And she said, I think it's Putin. I said, yeah, Putin in the short term for sure. But I think the biggest threat to the market is a policy misstep, using the Fed funds rate too aggressively, i.e. all these people calling for 50 basis point hikes. It's the wrong move. It's a way to look how flat the curve has gotten since June of last year. You do a 50 basis point hike, you're going to, even though 6 hikes are already priced in, this is going to get closer to inversion, and then you get a recession. So you don't want to do that. You want to start to sell off the long end of the curve, create supply in the market so yields go up on the 10-year and beyond, 10-year and 30-year, and slowly raise the Fed funds rate because 6 is already priced in, but don't mess with those expectations. If you do 50, then people are going to be looking for 50 and 50, and then that short end is going to go to 2. You invert the curve, we get a recession. So slow on the short end of the curve. If you want to tighten and deal with inflation, do it with the long end of the curve. Create supply, selling securities, getting cash. That takes liquidity out of the market. Just do it on the long end of the curve through the balance sheet, not through the Fed funds rate, and you can have your cake and eat it too. Deal with inflation, tighten conditions, but keep the curve steep and keep credit flowing. So that is my suggestion. And here are some of the key notes talking about that. They talk about a significant reduction in the size of the balance sheet would likely be appropriate. I think they can start that sooner. Just don't go too aggressively too quickly, but get some supply out there. Let that 10-year hover between 2 and 250. Keep the short end subdued, and this thing can go on for a number of years. Okay, the second thing is positioning. Managers are now at their lowest weight to tech since December of 2008. This was the last time that they were this underweight tech, was December of 2009. Took a couple months to bottom, and then you had a historic rally. It's not to say that it's going to exactly repeat that way, but the last time was mid-2016, 2006, and you got another couple years there as well. this is from the Bank of America Fund Manager Survey, which came out on Tuesday, and the survey was from the first and second week of February. 300 managers with $1 trillion under management. So they not only have their most underweight tech since December 2008, they're the highest overweight to cyclicals, banks, energy, and materials. The problem is the time to buy cyclicals was in 2020 when we were pounding the table, as GDP moves from 6% last year to 4% this year and back to the long-term trend next year, maybe 3%. I mean, 3% would be above trend. That would be great, but let's call it 2.5%. Money will flow back into sectors that can grow in a slowing environment. So what they've left for dead. And this shows the last 3 times that managers were this overweight cyclicals. Here's what happened to energy. You got an immediate correction and then a massive rollover. I don't think we're going to get the massive rollover, but I do think we're going to get immediate weakness. Here, you got a couple more months of strength in 2011, and then you got a big time rollover. And then in 2006, after this monster run up, you consolidated for another year. They basically did nothing. So same with financials. You got some weakness for a few months in 2006. You got a huge roll, one more month of strength in 2011, then a huge rollover. And then in 2018, you got a rollover, and they did nothing for 2 years, and then a big correction. So odds favor, even if they continue to go up, the cyclicals, they will go up at a much slower pace and just burn a lot of money. So it's like everyone wants them now. No one wanted them in 2020, and there are better places. We want to focus on what no one wants that's high quality, and we want to have these type of moves like from 2020 on versus these type of moves after everyone's in the same boat. Same thing with materials, rollover, sideways consolidation. Energy may run a bit more until Russia's resolved, but when you look out a couple of months, you may find the trapdoor is open and let out all the Johnny-come-latelys. Start to nibble at reasonably valued, not high price-to-sales tech/biotech. For the biotech sector, just to get back to their average multiple since 1986, the group would have to appreciate 24% to get back to the average price-to-book multiple, 155% to get back to the average price-to-operating cash flow multiple, and 112% to get back to the average forward PE multiple since 1986. Remember, recovery rallies never stop at their, quote, average. Just as they overshoot in pessimism on the downside, they overextend in euphoria on the upside. History helps. This is from Strategas via Jessica Menton from Bloomberg. Quote, it has paid investors to maintain a cyclical bias leading up to the first rate hike. However, the performance in the 3 months following that hike has struggled. So you see the banks, materials, and energy, they all do fine into the first hike, which is coming next month. After that, if you look 6 months out, the top performer is technology. And everyone's saying, get out of technology because it's a rising rate environment. Well, guess what? The market's already priced in 6 hikes. So that is already baked in. Now you're going to have slowing GDP growth, albeit good, but slowing. That's when tech can outperform. Communication services, which is the Amazons and all that stuff, it's basically tech part 2 since they broke it up. Here is the during periods of an increasing Fed's funds target rate since 1994, the best performing sector 3 out of the last 4 times has been tech when rates are rising. This goes against conventional wisdom. So this is not what the majority of market participants are expecting or positioned for. As I've said many times, the time to buy insurance is before your house is on fire. We were buying banks and energy in fall of 2020. You can click on these links in anticipation of rising growth rates and inflation. Now, in anticipation of moderating growth, GDP 6% last year, 4% this year, back to trend next year, we're buying those sectors which can grow in the face of a slowing environment, namely the biotech sector and China tech, Alibaba. We want to skate to where the puck is going versus looking in the rearview mirror. On Wednesday, Charlie Munger hosted the annual meeting of the Daily Journal where he explained why he doubled down on Alibaba and used margin debt to do so in Q4 for his position. And this shows the Hong Kong tech sector earnings estimates have just ripped higher in the last 3 months. On Thursday, I joined Paul Gray to discuss markets, inflation, banks, biotech, and China. Thanks to Paul for having me on. More on sentiment. 3 key takeaways from the Bank of America Global Fund Manager Survey. When banks and energy were in the gutter in fall of 2020 and no one wanted them, now that they've all doubled and tripled, no one wanted them. Now, doubled and tripled managers are tripping over themselves to get exposure. We are helping them out by lightening up our exposure into strength in recent weeks. We would consider reloading for a longer-term move on a material pullback in the sectors later in the year. Managers can't get out of tech and bonds fast enough. Look at this data here. Opportunities in selected parts of these groups will resume in coming months and probably much sooner. We've positioned aggressively in China tech and in biotech in anticipation of that. Managers are holding more cash than normal. As the market recovers, they're going to have to chase. Pillars for the market. 1.234 trillion authorized in buybacks for 2022 so far. Money supply and liquidity are still growing, but slowing rate of change will help inflation moderation on a lagged basis. So the peak money supply growth was last February. We're at about half that rate of growth as of December, and I think it's even cut further since. Tightening shows up on a lagged basis will moderate inflation. Tightening began a year ago. If you look at the federal deficit, has come down from 18.5% to 9.5%. The 2-10 spread narrowed by 110 basis points, reduces incentive to lend, and money supply growth peaked in February of 2021. Earnings are still rising, 224.89 and 247.53 for next year. The 10-year Treasury yield has been below 3%. Listen to this. The 10-year Treasury yield has been below 3% 20% of the time post-World War II. In those periods, the market's performance is 2 times as good as when it's above 3%. We're still below 3%. Consumer confidence has only been this low. It's in the lowest 3% since World War II. Despite this fact, retail sales surged in January, and JP Morgan Chase credit card data was up 8%. They're saying it's also continuing in February. That was the highest in a decade. As consumer sentiment and inflation are joined at the hip, we expect consumer to improve even more as inflation begins to moderate in coming months. Short-term view, AAII sentiment, bullish percent ticked down to 19.2%. This is one of the lowest readings in history. It often corresponds with lows within days, weeks, or months. Down to 19%. It's unbelievable. It's lower than it was during the pandemic. That's how bearish people are this week. So 19% bullish, 43% bearish, and 37% neutral. Fear and greed was at 41. Fear is still in the market. And the National Association of Active Investment Managers actually dropped to 53.49. That is always, with the exception of the pandemic, an inflection area. Why? Because as the market starts to move up, you wake up, or Ukraine withdraws their NATO application, this is all over. The market rips higher. They've got to chase like crazy because they're in too much cash. So that is that. Last few things here. Talked about the PayPal earnings. Carter did the Russell 2000 top 30 weights. The earnings power of the top 30 weights of the small cap Russell 2000 increased by 4.03% in the past 60 days. The price of the Russell has dropped over that period. In November, it was 243. It got down to 188. So while earnings power was improving, the sector was selling off, and it's still about 240 to 210. So, you're 15% off of its highs, and earnings are up. So that's kind of interesting. And the NASDAQ top 30 weights. NASDAQ, remember, had a 19% intraday drawdown a few weeks ago. The cumulative earnings power of these 30 stocks, top 30 stocks in the NASDAQ, was revised down by 42 basis points in the last 60 days. So they've lost 0.5% of earnings power. And in terms of price, since November, it went from 408 to 334. It's back at 360. So it's still down about 10% plus, 11, 12%. And the earnings power is basically the same. And then the Dow, which I did, same thing. The top 30 stocks was down 45 basis points in the last 60 days. And the price is down 363 to 340. So, 5-6%, whatever it is, 7%. That's fallen the least. This is kind of a multiple re-rating on the basis of rate hikes. But if you look at the 2-year at 154 or whatever it was, a lot of those hikes are already priced in. So I think the multiple contraction should stop unless they do something ridiculously stupid next month and do a 50 basis point hike and basically invert the curve and put us into a recession. But in the minutes they had talked about worries about inverting the curve. So let's just hope they know how to use the right tools not to invert the curve. Okay, economic data for the week quickly. Obviously, the inflation numbers came in hot. The PPI numbers, people were worried about that. So yeah, look, this has been more persistent than people expect. If you look again, we covered the CPI numbers. It was cars and it was energy is the input cost for everything. So energy is going to be the name of the game, whether that's Iran, Ukraine, or just seeing the rig count tick up, which we don't have yet this week. Let's see, last week. Yeah, so it's ticking up. I mean, the total rig count's up to 613. That's why I like the servicers better than the producers. More supply lowers the price. That doesn't help the producers as much, but it increases the servicers, the amount of rigs going up, and that's going to be good for those type of companies. All right, what else did we have here? We had a build in oil this week, actually, which was surprising. Retail sales, with consumer sentiment in the lowest 3% of readings since World War II, to the fact that retail sales blew the doors off. God help us when inflation starts to come down and the consumer gets hot. Retail sales is going to be through the roof. They were up 13% year on year, or 12.96. Industrial production was also a good number. Capacity utilization was better than expected. That's a really high number, 77.6. Inventories was a 1.1 million build versus a 1.5 million barrel draw. Building permits were better than expected. Continuing jobless claims were good. Initial jobless claims were not good. They missed expectations, but continuing is more important in my view. That keeps coming down to 1.59. And then, and that's the name of the game. So look, long call, a lot of information, a lot of good questions. Hope you found it helpful. We'll be back next week, same time, same place. In the meantime, make it a great one. Thanks for listening in. Bye for now.